one of the things that we're going to go through today and really spend a lot of time with is trend trade rules. And again, it's President's Day. Don't get your hopes up for any real trading to actually happen today. So it's a real good day to go through lessons and talk about some of the things that cause easy trend trades to happen. And then, look, I think, and you guys correct me if I'm wrong, but the easy trend trades with everything really perfect are pretty darn simple. So what I want to do is kind of go the opposite route and talk about number 2 in our trading plan. What are the things that happen on a chart that cause trend trades to no longer be very favorable? And I'll give you a couple of examples here. And again, one of the examples is our divergence indicator. And again, I want you guys to understand when you have a negative number, it doesn't matter whether it's -1 or -999. And this is something I will change in the new, it's going to say DIV, and it won't actually have the percent number. So short version is it's going to have DIV. So there will no longer be different negative numbers that will confuse you. People ask that question all the time. Think of it as pregnancy. You either are pregnant or you're not pregnant. And think of these negative numbers as either you have divergence or you don't have divergence. Okay? Does that make it a little bit easier? If you have divergence, it means that the market is probably going to go the other way. If you have negative number divergence on all of your charts, the market is almost guaranteed to go the other way, at least for a while. And what this means is that if you have a negative divergence number on all 3 charts, stop taking trend trade shorts. Does everybody understand that? No, is the answer to your question, Steve. You can't change the divergence numbers after the fact. So I appreciate that attempt. So does everybody understand this concept? Negative numbers mean divergence. It doesn't matter what the number is. And if you see divergence on one chart, you have to wonder, maybe it's going to go a little higher. If you see divergence on 3 charts, then it usually means stop doing short trades. Everybody okay with that thought process? The other, there's obviously a lot of things that will cause the market to go the other way. And Jason, you'll appreciate this. This is a picture of NinjaTrader 8 here. If you reach what we call an edge, or the last red or blue line on your chart, on the 14-2 chart, traditionally this is the spot where we want to stop doing long trades. So for example, if you get to the first red line, you're like, we could still do a long trade. Second red line, okay, we can do a long trade. When you reach the final red line before there's a big gap, that's what we call the edge of Fibonacci resistance. And again, one of the things that's going to be crucial in your progress and crucial in your reading of the software is a picture that we've used. I mean, this picture is from 2015, but it's very simple. If you have blue Fibonacci support and your trigger lines do not get below the support is going to hold. If you have a red line of Fibonacci resistance and the trigger lines get beyond the red line of Fibonacci resistance, it may break and turn blue. If the trigger lines get physically location-wise back below the red line will usually hold. Everybody understand that concept? Triggers get below, blue lines break. Trigger lines get above, maybe they break, maybe they go back the other way. So, the most important thing that we do is we read the areas that could cause reversals. And again, one of the other things that we look at tops or bottoms is that negative number. So for example, up here at the top, If we were watching this Fibonacci resistance and then we pulled back up into the resistance area and we had divergence, it means it's more likely to win. So we get a combination of indicators that go together. And again, one of the things that you'll see is that the market will make a very strong push into a support line. And when the triggers physically get below the line and it's really strong, again, look, I put number 3 on here on purpose. It's the same blue line, but it's a very different trigger line situation. So I just want you guys to think in your head, what are the fibs doing? What are the triggers doing around the fibs? And it's going to keep you on the right side of the market. Here's another example of strong triggers getting below a blue Fibonacci support. This support is very less likely to hold and more likely to turn into resistance because of the location of our trigger lines failing to get back above it. Again, Stephen, we use more than one trigger line, so we'll take a look at some instances, okay? And again, my goal for today is to go through and look at our 14-2 chart and really discuss 2 things. Number 1, divergence and when you can and can't use it. And number 2, the things that happen on a larger chart that will cause your trend trades to become lower probability. And I think when you understand what will cause high probability trend trades, which is pretty easy, and you really start to understand the looks that will cause trend trades to be less likely to win, you'll start going into your trend trades with a lot more confidence. Now, the second portion of what we're going to go through, and my intention is just to go through kind of all of it as we go. Obviously, the rules for a trend trade are right here. I mean, it's very, very, very simple. We need a pullback in price, touching fibs or mid bands, and we need a pullback in the oscillator. And there's 2 conditions, Stephen, this will answer your question. There's 2 trigger line conditions that we're going to see that will affect our trend trade. And again, the small triggers are these little faster ones that kind of move around with the market. And the 14-2 small triggers are what we call synthetic triggers or 14-2 triggers. It's all, 2 different names for the same thing. Location, location, location. If the small trigger lines are physically located above or not below, right? Above or not below, then we're going to look for our trend trade a little more assertively before we break below the trigger lines. Does everybody understand that? So again, we're going to talk about things that hurt trades, things that help trades, and then really defining where the area is that we're going to be trading from. So this is really going to be a trend trade special for us. The second look, and again, I think the rules are really simple. The hard part is which line do I trade from, right? So again, there's only 2 looks that happen. There's triggers on the correct side, and then there's the flip of it, which is, we still have the larger 14-2 triggers crossed up, which means we can still do long trades, but our small triggers are physically going down strong and below the synthetic triggers. And again, one of the things that we look for when we look at trend trades, we need to determine, should we get in at the first spot, second spot, because sometimes there's a lot of multiple choice that happens. So we're going to look at, again, these rules right here. When, and again, these are going to be obvious to you. I mean, this one's so easy, almost don't even need to teach it. When the 14-2 chart is really helping you, you get really, really easy trend trades. I think everybody gets that one. It's this one that people have trouble with. So again, look what happens. If you hit the last fibs on your chart, if all three charts have divergence, if there's trend trade rules met on your 14-2 chart. Again, let me show you what that looks like. When you reach this spot right here. So again, this is your 14-2 chart, so you may actually do a long trade from 1276.50 to get up to a trend trade short spot on the big chart. And again, you'll see when I put the background colors on here that this is going to be a lot easier for you. But once you reach this spot, if you continue to try to do long trades just because the triggers are crossed up, the small triggers, you're going to fail or have a really good chance of failing. So what we want to do, and what my objective is for this, session for us, is to go through the things that could cause trouble. And I just want to look at the 14-2 chart first, and let's slowly walk through the chart kind of going backwards. And again, you guys let me know if you guys have questions along the way, but short version is I'm going to draw, or I already drew in, we're going to talk about the yellow boxes on the chart. And again, I want you to think in your brain, what are the triggers doing? What are the triggers doing with the area that's in question? So right now, look, this green midband, green means support, is the area that we're looking at. So, and again, we're going to talk about it, inside of this box right here. If you were short, let's just say hypothetically, once you reach a green midband with your synthetic triggers crossed up and your trend trade rules being true, if you try to go short, you will probably lose. Does everybody understand that? Or you'll have a lower probability of winning. So again, we're going to discuss the areas that you basically have to stop following the direction of the small trigger lines. So let me show you what that looks like on the 5-1 chart. Because if you're only looking at the 5-1 chart, again, I want you to see something here. Again, the obviousness of our trend trade shorts kind of pops out at you now, doesn't it? This is trend trade short with all of our trigger lines heading in our direction. And then we end up with divergence. Now, as we talk about these rules, I want you to think about something, and I'm going to give you a little secret, okay? So remember, divergence is a negative number. Any negative number, right? Okay, does everybody understand this concept? So I'm talking about this spot right there with that negative number. And what you will need to do in order to look for a pivot stop out, right? Stop out of the prior pivot is find the prior pivot, which just so happens to be right there. So again, I want you guys to think, and when you guys are going back and studying your trades, right? Your trend trade rules are pretty simple. So I'm going to just copy paste them onto the chart here so we can look at them together. Your 14-2 triggers are strong and crossed in the trade direction. Well, that's represented by the background, and you can see the red triggers right here? That pretty much gives you free rein to go short with the triggers crossed down that strong. Now, one of the things that we talk about is where are the triggers located versus the synthetic triggers, right? So you guys remember that from the trading plan? Again, in the plan, if the triggers are on the correct side, so for shorts, obviously below, we want to get in at the best spot. Does everybody understand that thought process? So it's up to us to kind of determine where the best spot is. So we have to look at our charts and say, okay, triggers are below. So we look for the lower, better spots to get in. All right. All right. So again, just finishing up this thought. Where are you looking for a short? And you're looking for it at what? Your midband and fibs. That's what the rules say. So once your fib to fib oscillator's in the right spot, you reach the area, you're getting in. So, look, the more assertive entry is to get in on the way up into this window. The more conservative entry is waiting for the market flow to generate a down bar. So again, this is the same spot on the market flow chart. And again, you can see if you got in at the spot, you're getting in somewhere around right here. If you waited for after the reversal bar, you're getting in down here somewhere. So again, how are you going to handle your trades and what are you going to do? And again, I got a real big video on this, but short version is if you get to the prior low, you have to watch out for what? And again, this is part of our management rules, right, in the stops and management section. If you get to the prior pivot, high or low, get your stops up or down depending on direction and watch for the market flow. So the market flow gave a long signal right here, which would be an exit for you with divergence potential. And again, I want you to keep in mind the market doesn't always run in a straight line. If it did, nobody would take the other side of your trade, right? It'd be easy. So when you're doing technical analysis, we're going to get very, very technical on the reading. You're short, you're in from a great spot, things are great, you're thinking you're going to get rich, and what happens? You get divergence. Keep in mind, if you get divergence, what's going to happen? Feel free to type it in if you get. I want you to look for this every single time. Sometimes it doesn't happen, but most of the time it does. If you get divergence or you get a pivot stop out, you almost always get a pivot stop out on the other side. Well, it's not always going the other way, Tony. If you're at an area that says you're going to go the other way, then the answer is no more short trades. If you've yet to reach the area that you're trying to get to, then you're looking for a pivot stop out, which would be right here, to take your next short trade. Now, sometimes it goes a little further, sometimes it only goes a tick or two past. It just kind of depends. So again, really, really, really big concept, guys. When you have divergence on the small chart, I want you to think, where was my last pivot up here, and how can I go violate that pivot to the upside before I take another short? Is everybody with me on that one so far? Now, the other thing that we are talking about is, when do I stop doing trend trades? And again, this is where the 14-2 chart comes in and where we started out our lesson, which is if you hit the mid-band and it's all green and your triggers are up, it's going to bounce. So where this box is represented on our smaller chart is right here. Let me blow it up for you, right here. Now, if you ignore, so I want you to really think about something here. I'll just type it out for you. 14-2 trouble spot. That's where it's going to bounce from. When you hit something on the 14-2 chart, Tony, as you were just saying, and you have divergence potential, and it's supposed to bounce, it's not really a long trade per se, but it's more of a don't take short trades. Does that make sense? Because we've now reached a spot that will create lower probability trend trade shorts. So you can avoid the loss over here, which you would have had, or short-lived. And instead, right, you could have maybe taken advantage of going long at support with the trigger lines going up. Anyway, that's a whole nother story. Really what I want for the new user is when you hit the 14.2 trouble spot, stop taking trend trade shorts. Does everybody understand that concept? Do not take trend trade shorts after a major trouble spot on the big chart. And again, that's really what this whole lesson today is going to be about. Reading your 14.2 chart and seeing why it's a trouble spot. Do you guys understand it? It's trend trade long rules on the big chart. So it's probably going to bounce. Even if it fails, you're going to get a bounce. So let's go back and look at a couple other things that are in our plan that, are very well represented here on our chart. This is our 14.2 small triggers going down. Everybody agrees, right? So at this point on our smaller chart, our trigger lines are going down from the 14.2 chart. Now, on the larger chart, this box, if you will, is the place where we hit a support area. And one of the things that we talk about extensively is if you hit an area and you have a very large gap back to your synthetic triggers. And the flatter the triggers, the better. So does everybody understand this concept? We've hit a support line because we came from above it. And we have a large gap back to our synthetic triggers. This is the time where you stop doing trend trade shorts. And potentially, if you get an opportunity, you can take a trend trade long with that look. And again, all of these concepts are in the fib and trigger line reading video, but again, we're just going to go back and look at what it looks like. So when we go back, let me just find that spot for you guys here. Bear with me. I'm just going to squeeze this up a bit. This is the spot down here. So, again, I want you to think about conceptually, what are you going to be doing in the real world? In the real world, you're going trend trade short, right? Give or take, somewhere in here, because of the look on the chart. So, Tony, I'm going to go back to your previous statement, which was if you hit a trouble spot on the 14.2 chart, okay, so again, this is our trouble spot on the 14.2 chart. If you're not paying attention to that, you may accidentally, you may do this one, obviously. We're going to do this one. But look what happens, Tony. Remember when you said if we have divergence and we're at a trouble spot, it might go the other way? So now we're putting 2 and 2 together. Again, I want you to think about something. On the first pivot down here, no negative numbers, no divergence. Right? So this is the read over here on this first pivot. Everything's going down, no divergence, no negative numbers, no good reasons to not take one more short. Now we have a lot more respect, right? Again, there's 2 things that happen here. Look, a 1-tick pivot stop out and divergence, and we're at a trouble spot from the large chart. Which means what? If you try to go short after trouble holds, you're going to have a very low probability trade. So again, the idea is reading our larger chart and just there's only a few big trouble spots that we run into. Most of the trading is done on the smaller chart until we reach the trouble spot. If we get to a trouble spot and trouble says trouble will hold, we stop doing shorts. Now, what else could you possibly do if the 14-2 chart says you're going up? And your rules are now met for a trend trade long. See how we have, basically it's two things that happen. Number one, we have trouble spot that holds. And then we have pull back into, what could be potentially a trend trade long. And we have higher probabilities of winning once we actually get that. Now, just progressing forward, again, I want you guys to think about the concepts I talked about. Strong trigger, strong push up, right? Does everybody see it? Now, what's the next concept we just talked about? I'm going to tell you what it is, and you guys can repeat it. If you have divergence, what's going to happen? I want you to think about it. You have to get this in your brain. What happens? We exceed the prior pivot low. Just keep saying it to yourself over and over and over again. Here's your prior pivot low. We're going to exceed it. Does everybody see what I'm saying? If you have divergence, you're going to exceed the prior pivot higher low. Now, what are the, so let's bring this all full circle. What are our trend trade rules for trigger lines that are below our synthetic triggers? Let me bring them back up for you so you can read them with me here. If the triggers are on the wrong side of the 14-2 chart. Okay, I'm recording this, Ramon, so you can go back and watch the whole video when we're done. If the triggers are on the wrong side of the 14-2 triggers, what does it say? Get in at the last spot. Okay, so look what happens. When you're looking at your trigger lines, and again, I think this is pretty easy to see, right? The triggers, these are your 14-2 triggers. They're crossed up wide and green and up, and we're like, yeah, baby, give me another long trade, right? So one of the things that we do is we plot, this little white plot is right. So this little reversal bar marker, if you will, is the price at which a 14-2 chart will start making down bars. So when we add the rules all together and the read of our indicators together, we have a negative divergence. That means that we're going to exceed the prior pivot low, which means that our triggers are going to be below our synthetic triggers, which means we have a choice. Do we get in at the first area? Do we get in at the second area? Or do we get in at the last area to go long before the 14-2 reversal bar marker? So now we're talking about what? We're talking about reading our charts and our divergences and getting, what happens most of the time together. So when we're going to do that trend trade, right? And again, look, I'll copy paste the trend trade rules. When you do that trend trade, you're going to be like, well, where do I go long from? If you go long too early, you will get stopped out, only to watch it run away with all your money. So again, number 4 on here is where are the small triggers relative to the 14-2 triggers? They're below. So you don't look at the mid-band, you don't look at the fib, once you start getting into this window, where the box is here, this is the window where you start turning on your strategy, and if it generates a long signal, you go long. The negative number up here at the top is divergence. So does everybody understand that? If you have the negative number, it's divergence. If you get divergence, you stop out the prior pivot. Can I ask you guys a question? Look right here. Is there any divergence on this pivot right here? I'll put a big square on it. No divergence. What happens next? Pretty good money trend trade long. You know, if you got in at the area here, so, you know, again, you have a choice between a fib and a mid band, but let's just say you bought right there. You would have to put your stop below the trigger lines, right? So that would be your risk, 10 ticks, give or take. So again, you could buy the mid band, but you're coming off of Fibonacci resistance. So, and your triggers are down, so you'll probably go a little bit lower. I mean, you know, take your pick in here. Okay. All right, so let's go back. Let's do some more. Okay, would you guys agree that this up here is Fibonacci resistance? And for all intents and purposes, really the triggers aren't breaking through here. Agree? We have a little pivot stop out, and while the triggers are strong, they're not really above the red line. This is the look that will tell us to stop taking long trades. Does everybody understand that? So if we hit fibs and the triggers don't break through, you stop doing long trades. Everybody okay with that? Pretty easy. So look, let's go back and let's find that square. This is the square. So again, I think it's pretty easy to see the pivot stop out of the highs. But again, you have to understand that, again, you may not be going short here. Right? So again, before we talk about when to stop taking trades, let's talk about the trades that you might have done. Yeah. Maybe one trend trade here with a real strong large chart. So again, you know, this is maybe the window, and then you get divergence. What happens when you get divergence, guys? Just say it out loud if you know it. You usually will violate the last pivot. I mean, it almost always happens. So again, if you were going to take a second shot at a long, maybe you take it from there. And then once you have a pivot stop out at resistance, at the edge of resistance, this is where trend trade longs become horrifically low probability. So again, it's when do you stop taking trend trades? And again, if you opted into this one, trouble spot and divergence and resistance got you out. A lot of our traders will be going short here. If you opted into another long trade from the edges, I mean, and again, look, that's right at the edge. There's just a tight little grouping right there. This is the pivot stop out. After that down bar, you have to stop going long, or you will, more likely than not, get run over. Which again, you know, I'm going to walk forward and backwards. Look at your chart. You're breaking to the downside. You guys read it along with me. Do you see the negative number divergence here? I'll circle it. What does that mean for your next short trade? Say it out loud if you know it. It's going to stop out the last pivot high before you go short. Right? Can you guys see it now? And then you're short, you're like, yay, I'm going to get rich. And then all of a sudden you have another pivot with divergence, which means what? They're coming to get you. Now this one, you know, obviously not a lot of areas right there for going short. But look what happens. It's imperative that you recognize what happened and where you're coming from so you know where to get in next. And if you get short here and you have divergence, you don't lose. And then if something sets up, you get another opportunity. And again, this all stems from this one little spot right here on our large chart. Yes, we're doing long trades to get up there, of course. But once you hit the fibs and the pivot stop out and we're going down, can you see how now the short trades look a lot better, don't they? With strong triggers going down. And then what happens? You get to the big gap and you have to stop doing shorts and then you start doing longs. So again, it's imperative that you read your large chart. Look, these are easy. When the market's going up and pulling back and you're looking for just long trades because there's nothing in the way, that's easy. So I'm not handling the easy stuff today. I want to handle the difficult stuff, if you guys don't mind. I think it's going to be more advantageous for us to talk about the spots where you have to stop thinking about something. Again, look, there's three, we'll call it 4 boxes that we're going to contend with now. And again, I'll just go through them real quick. You guys probably remember this from what was that, Thursday of last week? We had a pivot stop out at the top. So again, look, we had divergence. What does that mean traditionally? Traditionally, it means we're going to take out the last low. Right? Well, they didn't because it was still going up pretty strong. But then we had a second divergence with a pivot stop out. I don't care who you are, when you do it, how you do it. If you have 2 divergences and a pivot stop out, okay? You guys understand this concept here? If you have divergence, you're like, all right, we might go lower. And then you have a second divergence that basically stops out the first one and then goes the other way, you have to stop taking long trades. And again, this right here, traditionally, actually, this is more, I have to say this is more of a help for a short trade than anything else. But let's just say you had a long. If you hit synthetic triggers from the wrong side, no more long trades. Okay? If you pull back into a trend trade short, these are all in the rules, obviously, of the plan, but this is the spot where if for some reason you were doing long trades, which I'm not sure you would be thinking about short trades. And then watch what happens. We get divergence. And literally the same thing that happened at the top happened at the bottom. You get divergence, and then you get a second divergence, and what happens? You have a pivot stop out. So literally, I want you guys to think about the price at which you will stop doing long trades. Once you get back below that prior divergence, so look, can I draw in a green circle right here so you guys will know what I'm talking about? Watch this. You guys see the green circle spot? That's the price at which the party's over. And look, I'll make a red one over here. Double pivot stop out, double divergence, and you have, again, look, it's not that it won't go, it's just low probabilities. So again, you're trying to decide for yourself when are you going to have high probability or low probability trades. And really the function of our 14-2 chart is to give us general guidance and tell us when to stop. So look, I'm going to make this box green since it's more of a helpful box. So let's go back and let's take a little peek at what? Our 5-1 chart. Because this is where the rules are met. So let's go back and let me just find the spots here real quick. Bear with me 2 seconds. All right, here's the spots. And you guys remember this. I mean, I know you do from the other day. So obviously we did this one Thursday. This was the spot where many of you went long. Double divergence, pivot, stop out at fibs without the triggers breaking through. Remember that little reason that we would stop taking short trades? This is the 5-1 chart. Well, I know a lot of you guys did go short here on Thursday. I think it was Thursday, the 16th. Maybe it was Friday. You were short here, but then you went long here. And, again, look, this is the spot that we got to, which was our trouble spot on our large chart. And we spent a lot of time talking about this last week. If you try to go long here, you are going to get run over and end up taking losers. So again, due to the 14-2 chart, longs are lower probability. Okay, so look at over here. Same thing over here. And again, if the theme repeats itself, that's kind of my intention for you guys here today. Do you see the prior divergence low? Do you see the divergence pivot stop out of that low? And the market goes up from here. Let me just make an arrow. You see it? So when you're sitting here and you're looking at your chart and you're like, "Oh man, baby, I'm gonna get myself a short trade right here." This is that red circle that we made. Not only did we have pivot stop out, again, these are some of the synthetic divergences, but we had multiple time frame pivot stop outs, multiple divergences on our chart. Remember we said if you have a bunch of negative numbers below you, shorts usually don't work. If you miss reading your large chart, if you miss reading your divergences, you're going to do the wrong trend trade. And you're going to lose, and you're going to go, why did I lose? The rules were met. Do you understand what I'm saying? It's not down here that you know it's going to happen. It's after the reversal bar up. As you start thinking about your trend trade short, which would happen in this area right here. Does everybody agree? This is the spot where you're thinking, hey, trend trade short rules. But when you add in the two thoughts that we've been thinking, double divergence, pivot stop out after this up bar, and it's on the larger chart too, and the smaller chart, so it's a double whammy, the market ends up going up. Does everybody understand that thought process? And again, as you guys go back and study your charts and look at these divergences, you're going to say, wow, 2 divergences in a row, the trend trade short lost. Let me stop doing those. All right, I'm going to work backwards. Again, look, remember when I said that the 14-2 chart was helping at that green box? Again, let me show it to you. This green box right here. That's a 14-2 chart look that helps think that we're going to go to the downside. Everybody agree? The triggers are down below and we pull back and you notice that we have divergence potential and you're like, well, hey, I wonder if there's a reason to go short here. When you look at your smaller chart, do you see anything that kind of sticks out to you inside this box? A lot of red Fibonacci resistances first, hopefully. Let me show you where the failure of most new users comes from. Because when you see it, you're going to be like, wow, that's so easy. So I'm going to type it out for you again. We're going nice and slow on this today. How about this? So not only does the 14-2 chart trigger say we're going down from here, we have red Fibonacci resistance. So what does that mean for you as a trader? Well, if you're not a counter trend trader, it doesn't mean anything. If you're a trend trade trader, you say, hey, low probability trend trade long. And you avoid, hopefully avoid, taking a loss just because your trigger lines are crossed up on your 14-2 chart. Now, I'm just going to throw this out there because you guys remember it from the day, don't you? If the trigger lines cross down and there's no divergence at the bottom and you get trend trade short rules, can you make some money? I think the answer is yes, huh? I mean, obviously, all in this whole area, the rules are met for short. So, again, this spot right here is more, you know, it's a go spot for short trades. And again, this is where you recognize, oh, look, a prior divergence high, pivot stop out. Somewhere in here, I'm going short and making $200. All right, let's go work our way backwards to the other one that we talked about. And again, this is real early morning trading, but here's our yellow box where we have, and again, let me remind you what it was on the big chart. Two divergences, which means it plots the line, and you have a second divergence and a pivot stop out. Does everybody understand this look? Again, divergence, you're like, okay, we're going a little lower. Second divergence and getting below the divergence, prior divergence line is like party over. Does everybody understand that concept? So when you see it on your smaller chart, right? Look, it's so tempting to want to go long, right? When all your triggers are going up and you have blue lines. And if you did go long, okay, I understand. It's cool. At some point, you have to stop going long. So again, we've got all the divergences from all the charts kind of superimposed on here. So it gets a little carried away, but there's only 3 time frames of divergence pivot stop outs here. So you say to yourself, wow, we stopped out the highs of everything. And I have divergence from the area on the large chart that also has potential divergence and a pivot stop out. After this down bar, with that look, what are you thinking? The first thing you think when you see divergence is what? Pivot stop out. When you see double pivot stop outs and double divergences on both charts, you think what? Hopefully, you'll start thinking no more longs. Right? Can you guys see it? Double divergence, pivot stop outs on both charts. Stop doing long trades. You can get a long to get up there, but once you get that, party's over. And if you don't recognize it quick enough, you're going to get sucked into trying to go long over here. Instead, what happens? You guys just call it out if you know it. The market goes down, and then what happens? Do we have divergence? No. Do we get trend trade shorts that have the potential to make a little money? I think the answer is yes from the mid-band. Now, look at how that trend trade ends up. Because you're thinking, hey, I'm going to get rich and make it down to the fib, don't you? I mean, I would. That's what we'd be thinking. What ends up ruining the party? Divergence. After the pivot plots to the upside. What happens when we get divergence, guys? Say it out loud if you know it. We're going to go stop out the last high pivot. Can you see it? Do you guys understand what that divergence means? It means we're going to probably go stop out the last pivot, which means what? If you're short and up a bunch of money, don't, take your money. All right, let's go forward a little bit here. Just bear with me. The divergences are from measurements of two different swings, price and indicators, which is in the indicator description portion. So I'm not going to get into that too much. All right, guys. So same thought process over here. What's the, this is more of a helping a trade than hurting a trade. I guess I had a couple of helpers on there. Just key areas that I wanted to talk about. What's happening, because somebody asked the question, the synthetic triggers are still above a fib. So there's two things that are happening here, which you can see. Number one, yes, our synthetic triggers are above the fib, but they're crossed down. So, again, look, when we hit this spot right here, we're starting to wonder if we're going to keep doing short trades. At some point, you may even take a loser in here, which I could get on board with, right? Maybe there's a loss in here somewhere. We'll go find it. When the small triggers roll up at the mid band with the big gap back to the synthetic triggers, what happens? Usually, the market goes up. So again, look, I want you to see it. Once you hit the mid band, you're like, okay, we'll see what happens. The triggers are down strong through it. You probably take one more short trade. Let's go dissect that area if you guys don't mind. What do you guys think? All right. Obviously, this is going to make a lot more sense looking at our smaller chart. So this is the time when you hit that mid band the first time. See the yellow box? So again, obviously we're saying to ourselves, if you were short, that'd be a great target, but this is the big gap back up. So what happens? Well, again, theoretically, we'd be looking for another short trade, right? Somewhere before the 14.2 reversal bar marker. So again, this, I can remember this day because I know what happened. We took a loser right here. I think we did that trade in class too. We tried to trend, this is basically your last resistance before the 14.2 reversal bar marker. Pretty sure we got a market flow sell signal there and took a loser, which I'm okay with. Right now, look at the green box. Everything rolls over at that support, right, and is a little more helpful. So again, it's the 14.2 chart's not always hurting. In this situation, the 14.2 chart, large gap back to synthetic triggers above fibs helps longs. Do you guys understand that concept right here? So again, the same thing that would, render short trades less effective also helps long trades if we get them. So we have to ask ourselves the obvious questions. If we're going to do long trades, where do we do long trades from? Well, we have two choices, fibs or mid bands, right? Basically. So here's your fibs. And let's say, you even said to yourself, look, I'm going to get in more assertively because it's two fibs and my small triggers are above my synthetic triggers. What happens, guys? It's the evil negative number, right? So when you're hanging on for dear life, saying, I'm just going to keep risking my money, what happens? You hit pink midbands, you have divergence. What happens when we have divergence? Again, same theme. We stop out the last low pivot. Can you see it? It's pretty powerful, isn't it? So what happens? We go a little bit further, and then you can take another long trade. And if you're scared because the triggers are down, you have a third chance at taking a long trade. Somewhere in there you're taking a long trade, right? Do you guys see how this divergence stops out the prior pivot? So if you were long, you have to manage recognizing what's happening with the triggers and the divergence. You don't have to, but you should. All right, and then you can recognize, hey, the large chart's really helping. How can I get paid on that? And hopefully you make 20 ticks. And then you say to yourself, wow, the market really went up hard, right? Would you guys agree that our small triggers are physically way above our wide up synthetic triggers? Which means what? You get a second long trade, or maybe a third if you had to do it 3 times. So you do one, you manage, and you have divergence and a pivot stop out. Then you do a second one, you make a bunch of money. You do a third one, obviously you stop when you get to resistance. And you end up on the right side of the trades. And again, look at what happened. This is the spot. And you can see the trigger said, hey, spot's not going to hold. And then eventually the trigger line going up and the big gap back said, help. Right? And again, I'm not going to go back and show you this trend trade long because that looks pretty easy, doesn't it? And that's an obvious, easy trend trade long right there. I want to discuss more of the trouble spots and the tricky looks, because once you navigate the tricky looks and the smaller chart better, you're going to do a lot better. 3 rules in here. This is really helping a short, obviously. So you can see we've got 14-2 chart hurting us. You can see divergence and testing the triggers. This is the edge of fibs without the triggers breaking through. That means you have to stop doing trend trades. If you're down here at 11 o'clock, would you agree you have to stop doing trend trade short? Yeah, let me go find it on the other chart here. And look, I'm not going through the easy ones, you know. This is the spot down here that we're kind of working our way backwards. This is what it looks like on the 5-1 chart. And again, you know, hopefully you see the easy one on the way down, right? Trigger lines going down, market pulls back into your area, and you get trend trade short somewhere in here. Do you guys understand that one? I mean, see how easy that is? Was there divergence before we got up to our trend trade spot? No. That gives us a higher probability of our trend trade short winning. And again, you know, this was the fib on the 14-2 chart, and I think it's pretty easy to see. We had a lot of blue lines there. Agreed? If you continued to do short trades, you ended up losing your money. Now, maybe you're not a counter trend trader. That's okay. If the 14-2 chart really does hold and the market goes up, can you see the easy trend trade long? Say it with me. No divergence. Small triggers physically above our synthetic triggers. We're getting in at, I remember some people that day bought 84. I know you guys remember that too, especially those of you guys that did it. So look what you end up with. No divergence, easy trend trade short. The 14-2 chart and multiple fibs said no more. And you waited patiently for a no divergence pivot, trend trade long with the small triggers on the correct side of the synthetic triggers. Can everybody see it? And again, as you're studying your charts and you're, when you're in the real world environment, so now we'll go look at this green box. Would you guys agree that when we hit mid-band and fibs here, and our triggers are way down here, that's a really helpful situation for our short trades? So we have potential divergence, fibs, triggers way down here. So, that's like the mother lode of all things good for us. Agreed? So let's go find that spot. Again, I'll just type it out. I know it's 14-2 chart. Really, really helping. Right? So again, 14-2 chart really, really helping. What are the rules that you can follow? And again, you have to have the right area and condition and rules met before you turn on your system. But would you guys agree that that's the last red Fibonacci line on your chart? So you have a bunch of red lines, but this is the last red line on your chart, and your 14-2 chart helps here. If you're a counter trend trader, you go short there. If you're not a counter trend trader, you don't get an easy trend trade short until, it took 25 minutes, and then you got to trade over here. But if you are a counter trend trader with the edge of fibs and the large chart really helping, you could have got some of that money. All right, let's go on. Again, as you guys work your way back to the charts, you'll start to see, I'm going to squeeze this up just a smidge. These are areas that are helping. Conditions and looks in your fibs and trigger lines that are helping. Right? Obviously, when you get a parabolic move, that's pretty easy. One of the hard things for us is it going to really keep going? And you'll see when there's no divergence and there's no pivots, it usually keeps going, right? So look, even this little retracement here, no divergence. And then finally you put in a pivot with divergence up here and it goes a little bit lower, which ends up changing the trend actually. Again, I want you guys to be able to see some very simple thought processes. When you go back and you're looking at trend trades, right? I want you to look at the pivot before it. Tell me what happened. Tell me how assertive you should be on your entries based on where your fibs and triggers are and if you had any prior divergence. And again, look, sometimes you're going to have a divergence. Right? Nothing is absolute, guys. So again, in a strong trending market one way or the other, you can have a divergence low and a fib low, and eventually it's going to break, right? Everything breaks eventually. So this would be, in my opinion, reading the fibs and triggers, a significant break of some fibs, which again, after divergence, we end up making one more push to the downside. This, in my opinion, and you guys, obviously have to go do your own studying, but this isn't enough of a big break on a double divergence pivot stop out that closes back above the line to warrant any more short trades. And remember, double divergence pivot stop out that closes back above the line, we're at least going to stop out the last high, which they did. Do you guys see it? And by the time they stopped out the last high, we've already changed the background color. Triggers have crossed up. So we can't do trend trade shorts anyway. This is where the visual of the negative numbers and the background color, I think, are going to be very, very helpful for you guys when you're looking at trend trades. Okay, this is the next box I have drawn on here. So, again, let's think about what happened. Okay, so let's start at the bottom down here. What do you guys see? Divergence from fib and the market changes trend direction up. Agreed? Now, this may not be your trade over here, but you're thinking to yourself, should I find a trend trade to go up to here? Well, I want you to think about, where did we come from? Did I have divergence? What happened on the last pivot up? And should I be looking for one more push up? Now, obviously, once we get into multiple resistances and divergences and we make down pivots, what's going to happen, guys? We're going to stop out the last low pivot. What does that mean for a counter trend trader? If you're at resistance with a pivot stop out and divergence potential, and you know we're going to get down here, can you think of anything that might go through your mind? Go the other way? That's just a thought. I mean, that's not a perfect edge trade because we didn't get up. If we had gotten up to right there where that circle is, a little more at the edge of that resistance, that would have been a perfect look for counter trend trade short. Divergence. Didn't really even have a pivot, did we, to stop out? You'll go back and you'll start seeing this. You'll be like, wow, the trend changed to down. No divergence on the low pivot, and I had a high probability short trade. Right? So look, this yellow box means that there was something on the large chart, whatever it was that day, that said it was very unfavorable for this trend trade long to win. If you traded in a vacuum, you'd be saying to yourself, what? Triggers are up, green mid-band, take a trend trade long here. Agreed? If you were in a vacuum, when you look at the 14-2 chart and it says no, 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 you're going to avoid that loss. You're going to take this winner with all the indicators pointing down. Look at this trend trade. And again, I'm just kind of doing it rather quickly now, but look, a little pivot stop out with divergence. What's going to happen? We're going to stop out the last pivot. And then guess what happens? You go down and make more money. And again, look, a pivot stop out with double divergence. Stop taking shorts. Every once in a while, one of them is going to win, right? It did win. But you don't know that. This is the first one after a double divergence in 3 days that you guys have seen win. Again, it's, situational awareness. If we're in a parabolic move and we've really broken a lot of divergences, then you can get away with it. If we're in somewhat of a range-bound day, this is the death sentence for trying to go short again. All right, let's go back and read. Again, I think this is an area that we had to be concerned with, but look what happens. Divergence at the top. What does that mean, guys? It means we're going to stop out the last pivot low. Can you see it? So it's not that again, some people will try to go long at support and they'll say, well, the triggers were above. And I'll say, well, you had divergence. It means you're going to go lower. So when you stop out the pivot low and then you start looking for long trades, you have a chance. Now, obviously, once we trade back up into the bottom of our triggers and we have what? Say it out loud, 2 divergences. Look at how less likely long trades are to win. Can you see it? It's always easy to see when somebody points it out to you. You've got to go back and, research it for yourself. Look, this is a divergence. I'm not too worried about it because we were in a nuclear strong up market. Again, contextually, right? We get divergences that will break. That's okay. It's just like if you hit Fibonacci resistance and it makes the market bounce. You have to wait for it to break, and again, when you've got a nuclear strong market, you're going to do more trend trade longs. So again, your thought process is what? Number one, and I pointed this out last week, but look, there's a little stop out of a little low kind of stab back pivot, and then you end up with a long trade that works closer to the right spot. You can go back and find hundreds and hundreds. I mean, look, watch. I'll randomly just skip back a ton of days here. Obviously, that's a 14-2 chart that the edge of resistance would, really warrant a counter trend trade short there. Does everybody understand? You can start to see it. Again, I put these squares on. You just have to be aware that I put them on because they were 14-2 chart areas that hurt long trades. And look, you're going to do the first one, I hope, right? With 15 fibs and everything going up, you're going to do the first one, but you're going to be aware enough to go, whoa, divergence and a pivot stop out, which is going to end your thoughts of going long. And then what happens? The market changes direction and you get an easy trend trade short. What happened on the pivot before the trend trade short, guys? No divergence. High probability. Got it? I'm giving away 20 years worth of secrets here. The market goes down, no divergence, high probability, one more short. The market changes direction. No divergence, one more short, divergence, no more shorts until it breaks. The large chart probably had a big gap here, something that said trend trade long, I would guess, by that look. So again, you're going to probably do the first short trade here. Maybe, maybe not. But then you have divergence at a large chart spot that says you're going back up. So again, guys, I want you to think about what's happening on your charts at any given time. And again, today's a holiday, so but when you have small triggers on the correct side of your synthetic triggers, you get in a little quicker, especially if you have no divergence on the pivot prior. If you have divergence on a pivot, you're going to look for the pivot stop outs now, aren't you? Doesn't mean you can't do a trade 2 or 3 times. Sometimes it takes 2 or 3 times for it to finish rolling off. Then when you get to the trouble spot on the big chart, you're going to stop doing trend trades on the little chart. Again, you'll see this concept. I mean, this is today, obviously, it's very choppy, but the market goes down, and what happens? We have divergence and a pivot stop out, right? If you were going to be going long from the edges, that's the spot. Can you see it? Pivot stop out, triggers up, edge of fibs. If counter trend trading isn't your thing, what happens after a divergence pivot? Well, we usually stop out the highs, and then what happens? It goes down. What happens if there's no divergence? We usually get one more down. I'm not saying there's great trades going on in here today. Now, if we get divergence on the low, you can almost bet money we're going to go stop out the last high pivot. Which again, when I start drawing boxes in the classroom, is like this. This is what I expect to happen because we had divergence on the lows and because we had double divergence on the lows with a pivot stop out. Can you guys see it right there? A low with divergence and a pivot stop out with bigger divergence even. Right here, it tells me, assuming we make an up bar, no more short trades. Can you see it? So again, we have to read our fibs, we have to read our triggers, we still have to follow the rules. But when you really break down the chart and the nuances and what's happening between trend trades that don't have divergence prior and trend trades that do have divergence prior, it's going to really help you, two things that I want. I want you to be able to pick the right spot. Right? So again, look, triggers on the correct side, especially when there's no divergence, you're going to be much more assertive in your entries. Triggers on the wrong side, especially after divergence, we're going to go stop out the last pivot low before we go up again. So again, it's two things. Where are the small triggers located relative to your synthetic triggers? Are they helping or on the wrong side? Right side for longs, wrong side for longs. And then go back and add to it the divergences. And then make sure that you're not running into one of these big major things on your 14-2 chart that look like this. If you run into a resistance and you have a big gap, long trades, not that you can't take the first one, but it's the second one after that that usually ends up as a low probability. And again, fib and trigger line reading is everything. Where are your fibs? Where are your triggers? What's your expectation? Throw in a little bit of divergence like we just saw down here at the bottom, and you're not going short anymore. You just know it. You know it's going back up here to 62.13 at least, if not higher. Now, it's holiday, so it may take a long time for that to happen. All right, guys. Hopefully this has been a helpful instructional tutorial for you on reading not only the large chart, helpful and hurtful spots, but really kind of breaking down the smaller chart and reading some of the divergences and what to expect when you see these divergences on your charts.